It's no secret that Michael Burry has been extremely gloomy about practically all forms of assets for years. He predicted that inflation will spiral out of control in May 2020, predicting it well before practically anybody else did. And he was correct. He was able to predict what would happen in the future by only looking at monetary policies, money printing, and government expenditures during that call. Massive layoffs have already started in most startup industries and Silicon Valley as a whole, in response to his recent assertion that the internet and information industries have an excess of white-collar workers. Burry currently believes that index funds as a sub-asset class are in a bubble and are about to implode because investors are overexposed to the S&P 500 index without consideration for the fundamental valuations of individual companies. He forecasts that stock indices will drop as equities as an asset class are sold in Massachusetts as the current recession deepens and inflation pressures overwhelm consumers and businesses. He believes that buying and holding stock market indices without giving them much thought is the beginning of a new bubble, since it lacks the fundamentals that bubbles require. In the end, Michael Burry was accurate when he predicted that the price of the Cathie Wood's ARK KETF and the Tesla shares would significantly decline. On these two bets, he purchased his long put options, but much too early. So he probably lost money. Burry almost always has the right answer, but he frequently picks the wrong moment to speak. Even though Burry's large short position in the housing market was premature, he still had a brilliant exit and gained a lot of money. Therefore, to gain a sense of what is likely to happen over the next several years, it can be useful to look into his fundamental market projections. So, what does Michael Burry anticipate happening next? Michael Burry asserts that he anticipates continued inflation, while the majority of financial analysts and central banks anticipated a deflation environment. He still believes that the opposite will occur. According to Michael Burry, central banks appear retaliatory and in a model given how interest rates are affecting exchange currencies globally. This is an indication that inflation will continue to rise in 1978 and 1979, since rising velocity outpaced declining money supply as a factor in inflation's ascent. According to Burry, the velocity of money is rising more quickly than the economy's money supply is contracting. Burry is unimpressed by large rallies during bear markets, since he is aware of how frequent they are. Burry claims that dead cat bounces are the most impressive. 12 of the top 20 NASDAQ one-day rallies occurred during a 78% decline from the 2000 peak. During the 86% decline from the 1929 peak, 9 of the top 20 S&P 500 one-day rallies took place. Before bottoming out 78% lower in 2000, the NASDAQ experienced 16 bear market rallies of more than 10%, with an average of 22.7%. After 1929, the Dow experienced 10 bear market rallies, with an average gain of 22.8% before bottoming out at 89%, according to him. Burry is unimpressed by significant stock market gains despite shaky economic fundamentals. This enables him to hold a short position for a considerable amount of time when he is correct. The following tweet was posted by Michael Burry on September 30, 2022. Yesterday, 13.48% of equities reached a closing above their 200-day moving averages. Currently at December 2007 levels, the low in 2009 was 1.2% and the bottom of 2022 was 2.8%. 38.43% of equities finished above their 200-day moving average on December 22, 2022. Therefore, price action needs to decrease significantly before Burry is likely to believe that the market has found a stable long-term bottom. Burry predicted in May that the S&P 500 may drop to 1,862 points over the following several years based on previous crashes. Depending on the monetary policy, market fundamentals, inflationary pressures, government spending, and national debt, this is an extremely bearish viewpoint. Let's now examine Michael Burry's prediction for the housing market in 2023. Michael Burry's predictions of surging inflation in a second round are a reflection on the mounting strain on the property market. Burry cited a recent blog post that emphasized the most current U.S. inflation numbers of 8.6% for May 2022, which was at a 41-year high, and claimed that high inflation has completely eliminated demand for mortgage-backed securities in June 2022. Other elements that were addressed in the blog post he read and quoted, but weren't brought up by Burry. Given his esteem for the real estate expert who authored it, Burry probably agreed with most of the comments made in the essay. The unexpected increase in inflation, according to a blog post Burry read, drove 30-year fixed mortgage rates up to 6%, which is twice what they were at the beginning of 2022. One of the 5 most difficult things the blogger has experienced in his 44 years in the mortgage industry is this unexpected increase in mortgage rates. It is comparable to both the 2008 financial crisis and the dot-com bust of the 1970s. The author also claimed that if investors fully understood how the housing market's issues would finally lead it to end, the stock market would have fallen much worse. According to the blogger, the housing market was under inflationary pressure as a result of the Fed's swift rate hikes, the invasion of Ukraine, and the sharp increase in energy prices. Burry believes that the economy's worst is yet to come, and many of his predictions will make it difficult for the Fed to cut interest rates because of the high inflation rate. High interest rates increase the cost of monthly mortgage payments and reduce the market for more costly residences, forcing homeowners to reduce their asking price in order to sell their properties. What is Michael Burry's current investment then? Currently, 60% of Burry's portfolio consists of real estate firms. Before, he invested the majority of his money in information-based or digital platforms. By investing in businesses with assets, infrastructures, and real-world services, he may be using this strategy to defend himself against inflation. The worst thing you can do during this period of inflation is hold on to money for an extended period of time, since its value decreases. Burry decided to invest money in his portfolio in the third quarter of 2022, rather than holding high short positions or simply staying in cash with limited investments for months as a result of his projections regarding inflation. Prison stock holdings now make up more than half of Michael Burry's portfolio. Just this reveals a lot about his economic philosophy. Does he believe that people will have to steal to eat or turn to crime as a result of hyperinflation? In 2022, should you invest in prison stock? He believes that prison stocks are the finest option to invest money at the moment because he puts his money where his beliefs are. However, according to Michael Burry, inflation emerges in bursts. When the burst resolves, it won't be due to Powell or Biden. Rather, it will do so because that is the fundamental characteristic of inflation. It finds a solution, tricks people, and then returns.